Hello everyone. Welcome to another session on the paper management of financial services. So in this block 3, we have as of now we have understood what are the different types of fund-based services which are provided by the financial intermediaries, like housing finance, like leasing and hire purchasing. Yesterday we talked about the very important services like asset securitization. So today we will understand on few other services which are used by every day by the customers or the consumers. So these type of services are basically the services of card, that those are card services. You might be knowing that we are using debit cards and credit cards on daily basis. So these are also services which are fund based services provided by the financial intermediaries. There are insurance services in terms of life insurance and non-life insurance services. We have come across mediclaim policies. Nowadays mediclaim policy is very much important in for every customer or every consumer. And finally we will understand what is the concept of crowd forward funding, and as well as a emerging topic which is the carbon financing. Now let us move on to these financing services one by one. First, let us move on to the card services. The nowadays when the corruption in the society has increased, and when there is always uncertainty when we have liquid cash with us, so the society at large now uses cards as a substitute for cash to facilitate the financial transactions. So now you might have heard about the term which is known as plastic money. That means the card which is made of plastic, which is used for only one with one single plastic card. We can able to manage our financial transactions without any cash transactions, which are without any physical cash transactions. So basically what we are using, it might be known to all of you that there are two types of cards, namely the credit cards and the debit cards. And this is of course known as the plastic money. And this card business market is also regulated by the Reserve Bank of India or the central bank. Now, what are the features of a card? Now, the size of the card is obviously it is a small, which is handy and which can be carried in the pocket or purse of a person. It contains the identification of a person. That means there in the card, the name of the person or the name of the person who is owning the card that is mentioned. It is additionally supported by electronically encrypted codes. So there are codes which is mentioned. There will be a chip which is there in the card which mentions the electronically encrypted codes. You might have come across the chip which is inbuilt in the card. The issuer entity authorizes the person named in the card to use the same for withdrawal of cash and settlement of financial transactions for purchase of goods and services. So the user who is authorized to use that card, that means the name of the user will be mentioned. So the user who has been authorized to use the card can use that card to withdraw cash from the ATMs, or can use the card to purchase any sort of goods or services. The card is issued without any charges or some annual charges. Sometimes it happens the card does not have any charges, but sometimes some of the cards have a annual renewal charges also. And not only that, few cards also come with several different facilities and features. Now each card, credit card and a debit card, carries a 16-digit ID number. So the behind the just the backside of the card, there is a 16-digit ID number which you have to give while you are making a online transaction. So it carries also in the card, you will find that it carries the date of issue and the date of expiry. Now let us talk about a credit card. Here we can see in this card there is a, this is the encrypted code which I was talking about, the chip. This is 16 number code, the name of the issue authorized person who will be using, and this is the expiry date which is there. And behind the card there will be a CVV, the code which the electronic code which is used by the person who is going to do a financial transaction. Without the CVV, the person cannot, transactions, financial transaction cannot be successful without that CVV code. That is the code which is very important to be kept confidential. So credit card is a physical or a virtual payment instrument containing a means of identification issued with a pre-approved revolving credit limit that can be used to purchase goods and services or draw cash advances subject to prescribed terms and conditions. So in a credit card, credit means it is of course a loan. So when a person is not having instant cash with him, then he or she can use a credit card. So at that point, a credit card defines that a person can avail loan from that card up to a particular limit. Like there are varieties of cards and each card will have a certain limit. Like suppose a salaried person getting an annual salary of around 12 lakhs, maybe he can have a credit card which gives credit card limit of around 1,50,000 or 2 lakhs rupees. So he can avail the credit of that 2 lakh rupees only. The card limit is set at 2 lakhs. He cannot go beyond that. Even suppose within that means he can make transactions or purchases within that 2 lakh limit. Now there is also a set limit for withdrawing cash in that particular card. Suppose the cash withdrawal in that card can be up to extent of 40,000 rupees or 50,000 rupees. So every credit card has a set limit which is at which the individual who is owning the card can have the financial transaction. The applicant is required to apply in a prescribed format to the issuer to get a credit card. Now, in order to avail a credit card, the person who wants to avail a credit card, he has to give an application to the bank so that he can be issued the credit card. Nowadays, it is so easy that you can go to your online portal and you can easily apply for the credit card, providing, because already when you have a bank account, suppose you have a saving account in a bank, so you can on one particular instant you can give your details for wanting or need a credit card, then it will automatically reach your doorsteps. To issue credit cards, the issuers are to provide a one-page key fact statement along with the credit card application containing important aspects of the card, such as the interest and the quantum charges, among others. So when I'm going to apply for the credit card in the portal, then I will have to give all my details. Let us assume that you have to give where you are working, or what is your monthly or what is your annual income, what is the rate of interest you are aspiring for. So everything, every details you have to fill it up along with the credit card application. Now, who are the parties involved in the credit card operations? It's the card holder, that means the authorized person of the who can withdraw money. It is the issuer entity, that means the bank, who is the issuer entity. It is the cooperating merchants, and it is the third party agencies. Now let us go to it one by one. Now, who are this? The card holder. The card holders use the credit card to purchase goods or avail service from different merchants. So it is a person who is holding the card and who is making of transactions, cash transaction on credit from different retail stores or merchants. So these merchants realize the goods after generating slip from use of credit card through card machine. So this all of you might have experienced when you go to a retail store to purchase anything. So we give our credit card, then there is a slip which is generated. One slip, it is being kept by the retailer or the merchants, and the other one it is given to us. So after then instantly you will see that the money from your bank account has been transferred to the merchant bank. The card holder has to ensure that the purchase value is covered within the credit limit fixed by the card issuer. I was just talking about that every credit card will have a particular limit of purchase. So whenever we are purchasing something on our credit card, we should know that yes, it is within the limit of my card. Suppose the limit is 1,50,000 and you have already exhausted 1,30,000, then you are left out with only 20,000 to be purchased. So they have to ensure that if the purchase value is within the limit of the card issuer. Now, issuer entity is the company who is issuing the credit card in the name of the authorized owner. So, issuer entity could be the bank or an independent credit card company, namely non-banking financial companies. After receiving an application for issue of a credit card, issuer entity scrutinizes the same based on applicant's background, including financial position and credit score. If request for issue of a card is accepted, then issuer has to fix a credit card limit and cash advance or withdrawal limit. So when the issuer entity, when you are applying for a credit card in the portal, that application is received by the bank. Suppose the bank is providing the credit card. So in that case, they will first scrutinize the background of the applicant, and they will check the CIBIL score, the credit score of the applicant. They will see the credit worthiness. Then they will accept the application and issue a credit card which is having a fixed limit, because that limit also will be fixed by the financial position of the applicant. The third player is the cooperating merchants. The cooperating merchants allows the customer to purchase goods or services with the help of credit card. The merchant swipe the machine and issue sales slip to the card holder. So when they are going to cooperating merchants, are the shopkeepers from where you can swipe the credit card and make any sort of transactions, that is purchase you can make from there. So when you are going there, swiping the machine, swiping the card on the machine, there will be two slips which will be generated. One slip the salesperson will keep with himself, and other one they will return it. So in that process, the merchants will receive the payments instantly and from the bank account of the customer to the bank account of the merchants. Then third party agencies, sometimes what happened, sometimes third party agencies are involved in credit card operations for handling checks. That includes collections and deposits of checks received from the card holders. So there might be a third party agencies which, like, let us say, as in nowadays there are several third party agencies like Phone Pay, Google Pay, then there is another app which is known as Bheem. So these are different third party agencies which are responsible, or which are the intermediaries responsible for collection of or transfer of the money instantly from one bank's bank account to the bank account of the merchant from where they're going to purchase the things. So these are the parties which are involved in the credit card operations. Now let us glance quickly on the benefits and drawbacks of the credit card. So what we can say, the instant benefit we get from the credit card is when we don't have money, we can easily buy anything which we want with that credit card. So that is a very big benefit that we can get. Most accepted method of payment. Of course, nowadays it is widely accepted around the world. Anything we can purchase on a credit card for a particular period of time without interest. interest free cash withdrawals. So credit card, when we are taking a loan, we are taking a loan for a particular period of time. So in case of credit card also, there will be certain cash withdrawal limits. So suppose in a limit of 1,50,000 credit card, there will be a cash withdrawal limit of around 50,000. So that 50,000 we can withdraw with interest free cash withdrawals are there, but again that is for a particular period of time. Now let us assume that after the interest free will be there for the next 60 days. So after 60 days, we have to pay the, suppose you are not able to pay the 50,000 rupees which you have withdrawn within that 60 days, then after 60 days, you will be charged very high interest rates. But within that particular period, it is completely interest free. So anyone who is in requirement of cash for a particular period of time, that means you know that yes, I'm going to have that 50,000 rupees after maybe within 1 month or 2 months, then it is beneficial for that person that he can have avail that instant money without interest. Unlimited reward points. I think all of us are aware about this. Whenever we are using the credit cards, there are so many types of reward points we receive. Like suppose sometimes there might be some discounts, there might be some cashbacks, what that we will be receiving, or some reward points. After accumulating a particular reward point, we will be getting certain benefits. So that is associated, facilities associated with the credit card. Insurance coverage. Most of the credit card nowadays are coming with the insurance coverage facility. That means suppose there is issues with the card, suppose there is nowadays with the increase in the online transactions, so there are always chances of that the money may be, suppose you are buying something for a particular of a particular limit and money is transferred. So suppose you have given 1 lakh rupees as your the purchase price, but maybe some amount, more amount has been transferred. So such type of things also is happening sometimes, which we might have faced. Suppose I have withdrawn cash, but the cash was not available to me. So in certain cases, at that point of time, you need to have some insurance coverage on that uncertainties. So that is also associated with the credit card. It also makes travel easy. Of course, it is simple and handy to carry. That is one part. And since it is widely accepted all over the world, it makes our travel more easier. There are, as I talked, there are so many discounts and cashbacks. Like suppose in case of Amazon, Flipkart, or several e-commerce sites, you will find, like suppose you want to purchase a mobile phone, so you can see while purchasing you can find out that if one purchases with a credit card of ICICI Bank, then he is getting a cashback of 5%. So that is what is in certain transactions of the credit card also we can use this, we can avail this facility of discounts and the cashbacks. It also improves one credit cost. Now how does it take place? Like every credit card has a certain time period to pay back the amount which we have taken. Now suppose the period is 50 days. So within that 50 days, if the person who has taken withdrawn cash or made or availed the credit card facility, if the person pays it within that particular period, then the CIBIL score goes on improving. So that again will help that person in order to avail loan facility if required in future. Credit cards offer safety. Of course, this is one of the point which is related to travel made easy. When we don't have any cash with us, and when we have the plastic money only in the purse, obviously it will help us in having our own protection, safety. So no one is going to act any sort of misdeed because you don't have cash with you. And it also keep a track on your expenses. Every month the credit card the issuing company of the credit card will send a credit statement of transactions. There we can very easily track the records of the expenses that has been made in the credit card account. So these are certain benefits which we can realize by availing a credit card. But apart from the benefits, there are certain drawbacks of using the credit card also. First of all, one of the important thing is that there is a lack of transparency in terms and conditions. Like suppose we avail a credit card, we use it for 1 year, and what happens after 1 year? They say that you have to pay a annual fees of around 1700 to keep your card active. So now sometimes what happens, they are not opening the all the financial things which are added to the card facilities. They are not opening that, so that is why there is a lack of transparency. Sometimes some cards might have or might impose certain fees related to all the different type of transactions. So that might happen, but which is hidden when they do not disclose while selling the credit card. Another most common feature is technical failures. So when we swipe the card, there might be technical failures. Sometimes more amount may be, suppose we have put rupees 1 lakh, some more amount may be transferred. So all those technical failures sometimes happen. Then sharing of credit card holders information. Now, if there are so many fraudulent calls nowadays, who calls like they are from government organization, from electricity board, and if then they tell you to share some of the information, and if you share the information, then entire amount is transferred to their account. So that is a drawback, because it is again related to the technical failures that happens when it is a technology driven thing. So many pros and cons will be definitely there. Now, impact of interest rate deregulation. Now, these card issuing companies, they do not have a restriction of imposing the interest rates. They don't have a band. As in case of a bank loan, they have a prescribed guideline of the interest rate. Here, since it is a deregulated part, then so what happens? Suppose the holder of the card fails to pay the amount within the due date, then from the next day onwards, on daily basis, the interest will be charged very high, which is a problem for the person who is holding the card. So that is what is a limitation here due to the deregulation of interest rates. And of course, since it is technical driven, there is ineffective redressal. Suppose there are any technical failures. Suppose sometimes when you are withdrawing the cash might not come. Suppose the transaction amount is much more. So many issues are there which might happen. So in that case, there is a very ineffective redressal mechanism. So this is all about the benefits and limitations. Now, who can issue the credit cards? Credit cards can be issued by scheduled commercial banks other than the regional rural banks with a net worth of rupees 100 crore and above are allowed to undertake credit card business either independently or in a tie-up arrangement with other card issuing banks, NBFC, with the approval of their boards. So every bank has a right, can issue the credit cards, but the bank's net worth has to be rupees 100 crore. Scheduled commercial banks have been permitted to set up a separate subsidiaries for undertaking credit card business. Now you have to have more liquid cash because you are providing the holder of the card and a period where you are not charging any sort of interest. Now for these banks are required to obtain prior approval from the RBI. Now the regional rural banks are allowed to issue credit cards in collaboration with their sponsor bank or any other bank. Even the NBFCs registered with Reserve Bank of India also shall undertake credit card business, but again they have to take an approval of RBI. Now let us move on to another type of card, which is a debit card. So debit card, again, every one of us are having the debit card in our pockets. So like a credit card, debit card is also a virtual payment instrument. It is also a plastic money. It contains the identification that can be used to purchase goods and service or withdraw cash with banks with the help of ATM. So automated teller machine, you all of you know from ATM, we are putting the ATM card, that is a debit card only. That ATM card we are inserting and we can withdraw cash. A debit card is issued by the bank where the individuals have a savings account. So debit card can only be issued by the issuer's bank when you have a savings account. Debit cards are also issued to an organization, a corporate entity who has a business account or a savings account in the bank with the bank. They can also be issued with they are also issued debit cards. Now, what are the benefits of this debit card? As we saw the benefits of the credit cards, there are also few benefits of the debit card. The use of debit card has provided customers instant access to funds which are in accounts with a bank. Therefore, debit card can be used to withdraw cash from ATM centers. Now, you have a savings account. Your savings account has some amount in it. So, when you are going to take out money from your own savings account, you need not go to the bank, then fill up the slip, then you are not withdrawing the money from the bank. It is very simple. You, with the help of a debit card, you go to ATM centers and you can withdraw money within fraction of seconds. So debit cards can also be used for paying bills in shops, hospitals, and hotels, for online purchase at domestic and international shopping websites. So debit card, as we are purchasing in credit cards, we can also do the same in case of debit card. In the debit card also, there are 16-digit number, expiry date is given, CVV number is also given. So with that, we can make online purchase, as well as through the machine, we can swipe the debit card, and also we can purchase goods from the shops, or we can make online bill payments from the hospitals and hotels. Most banks charge issuance fee, ATM withdrawal charges, and annual fees for the use of debit cards. So that is associated, whenever you have a debit card, that is associated with the fees of issue. It is associated with the ATM withdrawal charges and annual fees for the use of debit card. Debit card will have its own annual fees, but this cost of the debit cards annual fees or withdrawal ATM withdrawal charges are very negligible. Whereas when you compare it with the credit card cost, annual fee or annual maintenance of fee of the credit card, it is very huge. It will not come below 1000 rupees. It is higher in case of credit card, whereas it is very much less in case of a debit card. Now, RBI guidelines on the issue of debit cards. Banks are directed to formulate a comprehensive debit cards issuance policy with the approval of their boards and issue debit cards to their customer in accordance with this policy. The prior approval of the RBI is not necessary for banks desirous to issue debit cards to their customers. So it is as per the policy, the banks can issue the debit cards to all their customers who are having savings account. It will only be issued to the customers who are having savings accounts or current accounts with the bank. Banks shall not force a customer to avail the debit card facility and shall not link issuance of debit card to avail any other loan or service facility from the bank. So bank cannot impose or compel a person to take a debit card, or it is only the person who are having a savings account, they can avail the debit card. But the bank cannot forcefully give you a debit card if you are not availing that service. A bank would block a debit card after 3 unsuccessful attempts at an ATM. I think all of us might have experienced this. When suppose in an ATM, after 3 attempts we are unable to get money, then automatically the technique is that the card will be blocked for a certain period of time, because it is expected that someone is trying to intrude into the card by giving different pin numbers. So that is why for security reasons the card is blocked. This is done to prevent any unauthorized or fraudulent transactions. Now, RBI guidelines on loss of credit and debit cards. So the card users has to block a lost card immediately after being informed. So whenever there is a loss of the card, so what we are doing, we are calling a toll-free number and we are blocking the card. The card issuers have to provide detailed information on how to report loss, theft, or unauthorized use of a card or PIN. This must include multiple channels such as a dedicated helpline. Every bank or card has a helpline number, a dedicated number of SMS. So when we are blocking it, we have to inform through all the different means. Dedicated email IDs, interactive voice responses, clearly visible link on the website, internet banking and mobile app, or any other 24/7 mode of reporting. The card issuers shall immediately send a confirmation subsequent to blocking of the card to the card holder. Now, sometimes what happens, suppose you have a pickpocketing and the card goes out from your pocket. So at that point, instantly you can give a call to the toll-free number and block your card so that any sort of fraudulent activities does not happen. Now, these two are the card services which we had discussed now. Another type of service which is provided by these financial intermediary are the insurance service. Now, what is this insurance service? Insurance is used as an effective instrument to transfer risk. Why do we insure? It may be insurance of your own life. It may be insurance of the goods or assets which you have. Now, suppose you have a building, your own house, then suppose you have a shop. So there might be risks of natural calamities. So you are having an insurance. So and for that insurance which is being provided by a insurer, so in that case you are going to pay some maintenance amount which is in terms of a premium at a particular interval. So it is in order to hedge the risk, in order to transfer the risk, we are opting a insurance service. So insurance is a pooling of future unexpected loss by transfer of such risks to the insurers who agree to indemnify insured for such losses, to provide other economic benefits on their occurrence or to render services connected to the risk. That means they are foreseen an unexpected loss in future, so they are transferring the risks from the insured to the insurer, and the insurer agrees to indemnify the insured. That means indemnify in the sense they will compensate the loss which has been done by they will compensate the loss which has been made by any sort of natural calamities or any sort of accidents, anything. So indemnify means they are there to compensate the loss. So features of insurance, first feature is the risk pooling. Second one is risk transfer. Third one is indemnification. Risk pooling, insurers pool the risk, that is the spreading of losses for unfortunate few over the entire group. In process, actual loss is substituted by the average loss. So what happens? Suppose it is a big enterprise or big building which has to be insured. So one particular insurance company when they are insuring that particular building, then the entire risk of that company will be on the insurance company. And the entire risk of any sort of uncertainties or unfortunate situations will be going to the particular single company. So what they can do, they can have a risk pooling. So they can have, there will be several companies, 2 or 3 companies, which will do the insurance of the same building in different proportions. So whenever there is a loss, so that amount will be compensated by the insurance company in their own proportion of insurance which has been made with the company. So that is what is risk pooling. They are distributing the risk among different companies. Risk transfer. So this is very clear. When the in case of insurance, there is a risk transfer when the insurer agrees to compensate the loss that may occur either fully or partially. The insurer is the insurance company who will compensate the loss if any sort of uncertainty of financial loss gets transferred to the insurer from the insured. In case of any uncertainties, the losses are being borne by the insurer, and that is why the risk is transferred from the insurer to the insured. Indemnification, as I said, indemnification is a guarantee that any sort of financial damage which has been made or loss which has been incurred by any sort of natural calamity or any sort of unfortunate situations. So the insurance company is there to provide or make up or compensate that loss. There are 5 principles of insurance. First principle is the principle of utmost good faith. Second one is the principle of insurable interest. Third one is the principle of indemnity, subrogation, and the principle of contribution. Now, what is this utmost good faith principle? The insurance contract is done on utmost good faith. That is, in a contract of insurance, there is an implied condition that each party has to disclose every material fact known to them. That means, suppose there is a life insurance scheme I have availed. Now, when there is an insurance scheme, if I don't tell that I have so and so such and such diseases, or suppose I am doing a mediclaim, a policy, if I don't disclose all my diseases, so obviously that will be against that utmost good faith principle. So every party, each of the party, that means the insurance company as well as the person who is availing the insurance, must have to disclose each and every fact about him or her. Misrepresentation of the material fact makes the contract voidable at the option of the insurer. If any sort of misleading facts will be given by the insured, then at last, while claiming the insurance, when suppose something happened, you are claiming the insurance, at that point of time, the insurance company will misrepresent the material facts, and finally it will cancel the option, or it will make the contract void. Make the misinterpretation concealment of the fact has also some legal effect. Concealment is defined as a failure of application to reveal the facts when he or she is under obligation to disclose the same. So one should not hide any sort of facts. Both the insurer and the insured should not hide any sort of facts between them, so that the proper valuation of the assets can be made to be which is to be insured. Now, what is this principle of insurable interest? The insurable interest exists only if insured would suffer economic losses in the event of damage or destruction of insured object. For example, insurance of house or shop, damage to house will result into a financial loss to the owner. So it is also necessary that insurable interest must exist at the time of the loss. So whenever there is a insurance in the insurance contract, all the things will be mentioned in the insurance contract. Suppose there is a vehicle insurance, so there will be everything which is mentioned in the contract regarding all the different types of materials or all the different type of aspects will be which will be covered in the vehicle insurance. So suppose there is a damage to the vehicle, then what all things will be covered in the insurance policy, that will be clearly mentioned in the insurable interest. Indemnity, the principle of indemnity states that the insurer uh, he guarantees, the insurance company guarantees that in case there is a financial loss, so that loss will be due to any sort of damage or any natural calamities or any unforeseen conditions, that damage will be compensated, that loss will be compensated by the insurance company as agreed upon. So that means their present state will be recurred again by the insurance company. That is the law of indemnity. In other words, the insurance company agrees to pay not more than the actual amount of the suffered loss by the insured. That means suppose the insured has a loss of 1 lakh rupees, the insurance company will pay 1 lakh or less than 1 lakh, but it will not pay more than 1 lakh to the insured. Now, what is this subrogation? Under this principle, insured person is not allowed to make profit from the insurance contract. When you file a claim, your insurer can try to recover cost from the person responsible for your injury or property damage. This is known as subrogation. Your insurance company pays for a treatment, pays to your doctor for a treatment, but the accident has been made by someone else. So it might happen that the insurance, when you file a claim, the insurance company can recover the cost from the other person who is responsible for your damage. That is known as subrogation. Another principle is the principle of contribution. It is the right of the insurer who has paid a loss under a policy to recover a proportionate amount from other insurers who have converted the liability for the same loss. Like as I was just talking about the pooled risk. That means when a particular company, the particular building can be insured by 2 or 3 insurance company. So in that case, suppose it is both the insurance companies have insured a particular building. In that case, suppose there is a particular amount of loss, so both the insurance company will be proportionately, they will claim and cover the insurance. For example, if a house is insured against fire with 2 different insurance companies under fire insurance policy, and let us assume the sum assured is 5 lakhs, fire occurs in the house causing loss of 5 lakhs. So in that event, the insurer who paid full claim has the right to recover 2,50,000 proportionately. That means both the insurance company have to pay 2,50,000 each. So here it is distributed. The contribution has to be proportionately made by all the insurers. Now, what do you mean by deductibles? This is another principle. Deductible means deductible is a principle by which a specific amount is subtracted from the payment otherwise payable to the insured. Like suppose your car needs there is some damage to the car, to your vehicle, and you have claimed insurance policy for that. Now, before your claim is being settled, when you went to the garage for the repairs, so at that point of time, you have paid a certain amount of money, which is known as deductible in case of in the insurance, which is mentioned in the insurance policy. Suppose you have your deductible amount is 2,000 rupees, and your total amount for the vehicle is, let us assume it is 20,000 rupees. So you have paid 2,000 already to the garage to start the work. So another 18,000 will be disbursed from the insurance company. So deductible is the amount of loss which the insured has to bear in each and every claim. That much amount has to be recovered, that has to be borne by the insurer. That means the person uh, who has been confronted with the damage. The larger the deductible, the less you pay in the premium for an insurance policy. So when the deductible is larger, obviously your bearing will be larger, and so you are availing less amount of money from the insurance policy. So in that case, your premium is less. For example, if your policy states a $500 deductible and your insurance has determined that you have an incurred loss worth of rupees 10,000, you would receive a claim check of rupees 9,500. So this is how it is deducted. Now, what are the different types of insurance businesses? Basically, broadly speaking, there are two types of insurance businesses. One is a life insurance, other one is a GIC, general insurance. So under this type of life insurance, the risk associated with human life in general can be covered up to a specific amount, which is called a sum assured. So a person can insure his or her life and his health against the contingencies like death, disability, and surviving through law. In event of death, when suppose a person dies, then the dependents or the nominee will be reimbursed with the full amount that he has insured for. Now, when you are availing an insurance, you have to pay a premium, and the premium payment amount can be done in intervals of time, which can be annual, half yearly, quarterly, monthly, or limited term. Now, life insurance products can be different types of plans which we have come across. You might be aware about this also. Term assurance plan is a basic plans of insurance. Now, term assurance is a life insurance policy scheme. This plan is protection for a specific period for a specific sum assured. If life insured does not die during the term of the policy, there is no return of premium and the cover just ceases. The term assurance policy has no surrender value and no investment return. So it is only if the person dies only that person will get the amount that he has insured for. So this is a simple basic plan. Next one is endowment assurance plan. So in this case, endowment assurance plan is an investment oriented plan which pays not only in the event of death during the term of the policy, but also in the event of survival at the end of the policy period. So you have a policy period. Within that period, if you are surviving, then you get a sum assured. But in the basic term assurance plan, there even after your policy is matured, if you are alive, you are not getting any surrender value or sum assured in the above part. But in endowment assurance plan, you are getting the sum assured when you are still alive after the policy expires. Another scheme which is very popular nowadays is the money back plan. Money back plan, it is like an investment plan when endowment assurance plan is sold with periodical liquidity advantage. It's called a money back plan. That means you are giving premium every month. So let us assume. So after a period of 3 years, you will receive a cashback in your account. Let us assume 30,000, 40,000 based on the amount of premium you are paying and based on the policy. What is the sum assured? So you are going on recovering that amount periodically. You are going and getting that amount. That is known as a money back plan. Whole life policy, the name itself indicates that these policies provide death protection to the individual throughout his lifetime. It provides protection to those who are very much concerned about the family and dependents rather than earning return on investment. So these are not investment plans, whereas these cover the life of the individuals till the death. till the death, the entire life period. Unit link plan also, this is very popular. That means they are pooling the money in the form of premium, and they are investing in the stock market. So whenever we see what is the value of our premium that we have invested, we can get the value from the insurance company, that the units that they have purchased in the market, that has a particular net asset value or the worth. So here this is an investment plan. So unit linked life insurance products are those where the benefits are expressed in terms of number of units and unit price. The number of units which the policyholder would get will depend on the unit price when he pays the premium. The daily unit price is based on the market value of the underlying assets and computed from the net asset value. So it is the insurance company, they are doing the investment, and we can get to know where our investment, our funds has been invested, and what is the value of that fund, our invested fund at a particular point of time. So this is not a death, the protection plan of the death, but it is of the life, it is an investment plan. Now, non-life insurance is also known as general insurance. So it is a general insurance business. Non-life insurance business covers various types of insurance such as fire insurance, marine insurance, liability insurance, etc. So all the assets apart from life can be insured under the general insurance. Another type of policy which is nowadays, which is availed by all the types of persons, is the mediclaim policy. You might be knowing that there is a huge cost involved when we have our physical or health issues. So that is why we go for mediclaim. This is very popular policy which is done by all the individuals nowadays. Mediclaim is a form of insurance wherein the insurance company reimburses the policyholder for any medical expenses that he or she might have incurred in the policy period. Suppose you have a mediclaim policy, that means you are again paying the premium amounts every month. So in that case, what happens, suppose after paying 1 year or 2 years, suppose the sum assured of your mediclaim, the amount of mediclaim is up to a limit of 5 lakhs. So let us assume that you have paid the premium for a period of 1 year, and next year, the second year, some medical complications happen and you have to be admitted in the hospital. So at that point of time, the mediclaim, the company, the insurance company will reimburse the medical expenses which has been incurred, and that too up to a limit of 5 lakhs rupees. The insured can either submit the relevant bills, that means first the insured will make a payment and then after that it will submit the relevant bills to get it reimbursed from the insurance company. Or sometimes what happens in the insurance mediclaim policy only, it is mentioned that the particular hospital, the policy is linked with different hospitals, like it can be linked with Apollo hospitals or different other groups of hospitals. So if suppose you are doing your health, you are going for health issues in that particular hospital, directly there will be a transaction by the insurance companies to the hospital. So in view of high cost of hospitalization, mediclaim policies are necessity to make healthcare affordable to a larger mass. So some important aspects of mediclaim policy, these are very important. Premiums vary in terms of the premium paid for mediclaim policy differ. It varies in terms of age, sum assured, policy period. Similarly, suppose the person is above 50 years, the person is moving to 60 years, he becomes a senior citizen. So premium goes on exaggerating. So premium will go on advancing, or it will increase while you are having a increase in your age. Similarly, when you are covering the entire family, suppose you are covering only yourself, the premium will be less. Suppose you are having mediclaim for your entire family, then there will be a very different type of premium. Now, claims are usually made through a third-party administrator, which is TPA, but some insurers deal with the claims in-house. Then a mediclaim policy cater to different needs of the individual. One can choose for different individual policies like group policy. In different organization, you will find a group policies which are there for the employees of the organization. There can be senior citizen policies. There can be also the maternity policies. Now let us understand quickly what is a crowdfunding. So when this is mostly applicable for startup companies. So when a startup would like to have money from different sources, they can of course go for venture capital funding. But if not possible, then they can approach to different small investors who can invest their money in the project, and after the project is established, the money can be given back to them. So crowdfunding means it is funding from a crowd which comprise of different investors. So in most of often used by startup companies or growing businesses as a way of accessing alternative funds. It is an innovative way of sourcing funding of new project, businesses and ideas. So crowdfunding is a non-traditional method for raising funds for businesses through the collective effort. So it is an effort which is made from the crowd. So it is a collective effort of friends, family members, customers and individual investors. So they are going to mobilize the funds for that startup. This method helps to mobilize small amount of funds from large number of individuals through online, via social media and crowdfunding platforms. There are several crowdfunding apps now, platforms. So through that also you can give your need of funding of money required and you can avail the money. So crowdfunding as a source of fund is mainly useful for small entrepreneurs, business people and small enterprises. So these are the platforms in India who can go for crowdfunding like Indiegogo, Wishberry, Keto, Fundline and Catapult. So these are few popular platforms where the crowdfunding is being done. So the startup companies, small startups who would like to avail crowdfunding facilities can definitely go to this websites and they can avail the crowdfunding platform. Now, another type of finance which is a hot cake in today's global world is the carbon financing. Now, as we know, with the increase of global warming, so environmental sustainability is a great challenge. So with the concept of having a proper environmental sustainability, the concept of carbon finance is into picture. So this is a contemporary topic which is being adopted by different organizations and corporates nowadays. So what is the purpose of this carbon finance? The purpose of carbon finance is to reduce the global carbon emissions. So ultimate objective is environmental sustainability by reducing these carbon emissions. So now the government has set up a limit to the extent of which the organization can emit their carbon. So suppose they are able to reach that limit, then they are earning the carbon credits. So it serves as a financial mechanism aimed to incentivize and provide opportunities for businesses and individuals to reduce their carbon output. So it is a mileage which is given to that particular organization who can reduce their carbon limits. The carbon finance offers an immediate opportunity to reduce the overall effects of the climate change by promoting the CHG emission reduction. So in case of this, suppose they are saving they are not having a high level of carbon output and they are saving the carbon output, then that carbon output they can lend to some other organization who is in require of that carbon. So that is the concept of carbon financing. The carbon financing involves the creation, allowances, and exchange of these carbon credits or carbon offsets in voluntary markets and compliance-based markets. So their job is, in case of a carbon finance, they are creating the carbon emission. They are creating their having that emission up to a particular approved limit by the government, and the remaining part they are going to transfer or give it on a credit to the other organizations who are in requirement of that. So carbon credits are created when 1 ton of carbon dioxide is removed from the atmosphere. So suppose an organization is able to reduce 1 ton of carbon from the atmosphere, that organization is given the carbon credits. So this is accomplished through a project management companies that own and operate low emission projects. And the other method, which also reduces the overall concentration of carbon, is accomplished when companies alter their business practices. Suppose they go for more eco-friendly product, then obviously the carbon emission will be reduced. Projects record and verify that they have successfully sequestered or prevented 1 ton of the carbon from entering the atmosphere. So when they are reducing that 1 ton of carbon content from the atmosphere, they will be earning that carbon credit. Some few examples of these projects includes the wind power and the forestry projects, which are into the line of this carbon financing and towards the maintaining the environmental sustainability of the entire society. So with this, we come to the end of the session. In the next session, we will start with the block 4. Thank you.